What if the greatest market crashes of the last century were not random shocks, but carefully engineered opportunities that allowed a tiny elite to multiply their wealth while the rest of the world panicked? What if fortune in the markets was never about luck, but about being positioned before the catastrophe even had a name? This question sits at the center of a pattern so consistent, so deeply embedded in financial history, that ignoring it almost feels dangerous. Every time a crisis erupts, from stock market collapses to global recessions, billionaires do not merely survive, they accelerate. They emerge with greater influence, greater assets, and greater control over the very systems that supposedly failed. You can see the first signs in the moments before every major downturn. Strange capital flows, sudden liquidity movements, institutional sell-offs disguised as routine adjustments. Most people interpret these signals as noise, but high net worth players read them as invitations. They understand that volatility is not an enemy, but a weapon. And once a crisis begins, the dynamic shifts entirely. While families lose jobs and retirement accounts evaporate, private wealth circles are already deploying capital into distressed assets, buying companies for fractions of their former value, and influencing policy responses that guarantee their gains. The public sees chaos, they see structure, but here is the part few dare to examine. Crises do not simply expose inequality, they reinforce it. Every crash resets the playing field in a way that benefits those with information, time, leverage, and networks built far outside the sightline of ordinary investors. Financial historians have documented this cycle repeatedly, from the panic of 1907 to the dot-com burst and the global meltdown of 2008. The same names, the same families, the same funds appear on the winning side of every disaster, as if guided by a map the rest of the world is never allowed to see. And when regulators claim these outcomes are unavoidable, that markets are unpredictable, those explanations feel more like narratives than truth. It raises a deeper question about power in the global economy. If crises elevate the same groups again and again, are they merely events to endure, or are they mechanisms with beneficiaries built into the design? The more you analyze the timing, the trades, the political pressure applied in the shadows, the harder it becomes to treat any of this as coincidence. And that is exactly why understanding this hidden architecture matters for anyone trying to make sense of modern markets. Before we continue, share your perspective in the comments and tell me whether you have ever felt the system reacts differently for different people. Also, if this is opening your eyes, tap like and check whether you are subscribed, because what comes next may shift the way you read every financial headline you see, and this is only the beginning as we move into the next layer of the pattern. The deeper you look into financial history, the clearer it becomes that crises rarely emerge from a vacuum. They unfold in slow motion long before the public ever senses danger, shaped by patterns that insiders recognize instantly. In every major downturn, there is a moment months or even years earlier when the trajectory becomes unavoidable, not because the system is fragile, but because the incentives pushing it toward rupture are too profitable for certain players to resist. Long before newspapers announce a recession, liquidity in critical sectors begins to tighten, credit conditions quietly shift, and powerful institutions start reorganizing their portfolios with uncanny precision. These moves are subtle to the untrained eye, yet they form a narrative that repeats across time. Consider how cycles of speculation escalate. Asset prices climb not because of organic growth, but because capital from institutional whales floods into specific sectors, creating an illusion of unstoppable momentum. Retail investors, encouraged by optimistic forecasts, rush in believing they are part of a historic opportunity. But insiders treat these surges differently. They monitor volatility, credit spreads, and political appetite for intervention. They know exactly when the optimism is no longer sustainable. And as the market reaches its tipping point, they begin to rotate out, gradually at first, then aggressively. By the time ordinary investors feel something is wrong, the exit doors have already narrowed. This strategic withdrawal has been documented repeatedly. In the years leading up to the 2008 crisis, certain hedge funds executed positions that only made sense if they anticipated systemic failure. During the dot-com bubble, major players reduced exposure months before valuations collapsed. Even earlier, in the decades following the Great Depression, families with generational wealth consistently moved capital based on signals that the public never accessed. These patterns do not imply omniscience. They reflect an ecosystem where access to information, influence, and timing creates structural advantage. Yet what makes this dynamic even more revealing is how crises themselves become catalysts for massive wealth transfer. When panic forces markets downward, distressed assets appear everywhere. Companies with strong fundamentals collapse under pressure, entire industries bargain for survival, and governments intervene with policies framed as stabilizing but disproportionately beneficial to those positioned to capitalize on them. This is not merely reaction. It is opportunity engineered by decades of understanding how fear shapes markets. And once the recovery begins, the hands that held liquidity during the darkest moments emerge, owning the very infrastructure that will define the next cycle. The question that lingers is whether this pattern is accidental or if it represents a structural feature embedded in the financial architecture itself, one that continues to reward those who anticipate the collapse long before anyone else realizes it has begun. What becomes even more striking as you trace this pattern across decades is how effectively the public is kept focused on the wrong signals. While insiders interpret financial stress through data, liquidity behavior, and geopolitical shifts, the average person is guided by narratives designed to soothe, simplify, or distract. This is not accidental. It is part of a psychological mechanism that allows major players to reposition themselves quietly while the broader population remains convinced that everything is still manageable. Analysts on television repeat comforting explanations, politicians insist the fundamentals are strong, and financial influencers highlight isolated success stories to maintain optimism. Beneath that confidence, however, the real story unfolds in silence. This divide between perception and reality is one of the most powerful tools available to those who profit from volatility. When people believe the system is stable, they are less likely to question unusual market movements or shifts in policy. They accept temporary downturns as natural, unaware that elite investors are already preparing for a deep correction. It is in this psychological gap that wealth extraction becomes easiest. By the time the truth becomes undeniable, the decisions that guarantee massive gains have already been executed. The public learns about the crisis only when the consequences are impossible to hide. Another part of this dynamic is the intentional complexity of financial language. Terms like liquidity crunch, credit event, macro headwinds, and systemic contagion create an aura of expertise that discourages deeper inquiry. The more complicated the explanation sounds, the more people assume the situation is beyond their understanding. Yet behind these technical words are simple realities. Risk is shifting, capital is repositioning, and someone is preparing to take advantage of what comes next. Complexity becomes a shield that prevents scrutiny at the exact moment transparency is most needed. There is also the emotional dimension. Fear and hope are powerful drivers, and those who understand these forces can steer market behavior long before any official announcement. Retail investors often react to headlines, but insiders react to patterns. They know that sentiment moves faster than logic, and they exploit the delay between emotional reaction and rational interpretation. This gap allows them to accumulate positions at low prices or escape exposure at the peak, all while maintaining the appearance of normalcy. The most revealing part is how coordinated these psychological mechanisms appear when viewed historically. Different eras, different crises, different technologies, yet the same emotional choreography repeats itself. Confidence builds, doubts emerge, reassurance follows, and then collapse arrives with a force that feels sudden but was actually years in the making. And when the dust settles, the narrative resets, leaving the deeper structure untouched, ready to operate again in the next cycle. As the psychological choreography unfolds in public view, another layer of the system begins to operate beneath it, one built on institutions that quietly shape the trajectory of every economic cycle. Central banks, sovereign wealth funds, multinational lenders, and private networks of citizen capital behave not as passive observers, but as engines capable of influencing the direction and intensity of a crisis. Their decisions create ripples that eventually become waves, and those waves define who suffers and who thrives. When a central bank adjusts interest rates, provides emergency liquidity, or signals a shift in monetary policy, the effects are not evenly distributed. Insiders interpret these moves long before the public grasps their implications, allowing them to position themselves ahead of the impact. What makes this structure so powerful is that it often operates without explicit coordination. Each institution acts in its own interest, yet their combined actions form a pattern of influence that consistently benefits the same groups. For example, when markets begin showing signs of stress, central banks might intervene to stabilize credit. To the public, this appears as a protective measure, but to institutional investors with access to forecasting models and political insights, it represents a signal to adjust their strategies with precision. Liquidity injections, regulatory adjustments, and currency interventions all create predictable outcomes for those who understand how these tools redistribute risk. At the same time, large private funds and financial conglomerates begin repositioning capital globally. They move assets into sectors shielded from volatility, purchase distressed companies at suppressed valuations, and use geopolitical uncertainty as justification for restructuring portfolios in ways that would be risky for ordinary investors. This is where influence becomes even more visible. These entities possess the data, relationships, and analytical power to anticipate how government responses will unfold. They know which industries will be supported, which regions will receive stimulus, and which sectors will be abandoned. To them, crises are not interruptions, but transitions, windows in which the architecture of the global economy can be reshaped to their advantage. Yet the most revealing element is how these institutional forces shape public perception. Policy announcements are framed as necessary safeguards, even when their real effect is to consolidate financial power. Reports emphasize stability to calm markets, even when internal forecasts anticipate deeper turbulence. The narrative presented to citizens is crafted to maintain order, not to reflect the full reality of what is happening. And while people respond to reassurance, major players interpret the same announcements as tactical opportunities. This disconnect amplifies the gap between those who experience crises as sudden shocks and those who navigate them as strategic cycles. Before we continue deeper into this structure, share your thoughts in the comments. Do you believe these institutional forces shape crises more than the public realizes? Your perspective adds depth to this investigation as we move forward. What becomes increasingly clear when you analyze these institutional forces is that the super rich are not merely reacting to crises. They are anticipating them with remarkable accuracy, using strategies that rely on information asymmetry rather than speculation. Long before a downturn becomes visible, wealthy investors study subtle market distortions, the way meteorologists study atmospheric pressure. They monitor credit spreads, widening in specific industries, observe shifts in commodity inventories, track unusual cross-border capital flows, and analyze geopolitical signals that rarely make headlines. To them, these indicators are not noise, but early warnings that a financial storm is approaching. One of the most powerful tactics is strategic diversification, but not in the sense promoted to retail investors. Billionaires move capital into assets that historically surge during instability, such as certain currencies, farmland, industrial metals, private equity opportunities, or emerging market bonds, positioned to benefit from currency devaluation. They hedge not to avoid loss, but to amplify gains when volatility strikes. Many also place calculated short positions or acquire options that become enormously profitable during market corrections. These moves often appear risky from the outside, yet they are grounded in data models built on decades of crisis behavior. Another advantage is their ability to negotiate privately in ways ordinary investors cannot. During periods of uncertainty, corporations facing liquidity challenges quietly seek capital injections. Wealthy individuals and private funds step in, securing ownership stakes at valuations that would be unthinkable in normal market conditions. These deals often remain undisclosed until the recovery begins, revealing that entities once on the brink of collapse are now controlled by new hands who saw opportunity where others saw only danger. It is a structured process of wealth transfer disguised as stabilization. Timing also plays a critical role. The super rich understand that crises unfold in phases, each offering a different type of opportunity. The initial panic rewards those positioned for sharp market drops. The consolidation phase benefits those prepared to acquire distressed assets. The recovery phase favors those who accumulated influence during the chaos. At every stage, strategy replaces emotion. And because these players operate with teams of analysts, economists, and political advisors, they rarely misinterpret the signals that guide their decisions. But perhaps the most revealing aspect is how these strategies create self-fulfilling outcomes. When enough powerful investors reposition their assets simultaneously, their actions influence the very markets they are preparing for. Liquidity dries up faster, confidence erodes sooner, and the crisis intensifies in ways that validate their earlier moves. This feedback loop blurs the line between prediction and participation, raising a deeper question about whether billionaires simply foresee crises or subtly accelerate them. And that question becomes even more significant as we explore how unevenly these shocks distribute risk and reward across society in the next layer of this unfolding pattern. The deeper you examine this dynamic, the more unavoidable one truth becomes. Crises do not impact all levels of society equally. They expose an imbalance so ingrained in the global economy that it operates almost like an unwritten law. While the majority experiences uncertainty, job loss, evaporating savings, and collapsing credit, the wealthiest individuals encounter something entirely different. For them, a crisis is a moment of expansion, a chance to acquire influence and assets at prices unreachable during periods of stability. It is not that they escape damage entirely. It is that the structure of the system absorbs the impact on their behalf. This uneven distribution begins with access. The super rich have resources that shield them from the early waves of a downturn. They can relocate assets instantly, move capital across borders, restructure debts privately, and secure exclusive financial instruments unavailable to ordinary citizens. When credit tightens, banks refuse loans to small businesses, but extend generous terms to high net worth clients. When liquidity evaporates, institutional partnerships open channels that bypass the limitations affecting everyone else. The crisis becomes a filter. It restricts possibilities for many while expanding them for a few. Another factor is the architecture of ownership. Wealth is not simply measured by cash. It is measured by equity, land, intellectual property, energy resources, and strategic infrastructure. During a downturn, these assets may temporarily lose value on paper, but they rarely disappear. Instead, they consolidate. When competitors fall, dominant players expand their reach. When companies collapse, their assets are sold to the highest bidder, often someone positioned to capitalize on the chaos. Even real estate, which many people view as a stable store of value, becomes a tool for accumulation. Forced sales and distressed listings give well-positioned investors opportunities to reshape entire markets. Psychology also plays a critical role in this imbalance. Crises generate fear, and fear drives people towards short-term decisions. They sell investments at losses, cancel plans, and accept unfavorable terms just to regain a sense of control. The super rich, however, operate from a different emotional baseline. They have the cushion to think in decades rather than months, to analyze rather than react, and to build strategies that transform temporary turmoil into future dominance. This difference in perspective is not merely personal. It is systemic, reinforced by advisors, institutions, and networks designed to preserve and expand wealth even in the darkest moments. What emerges from this contrast is an unsettling realization. Crises do not merely reveal inequality, they amplify it with remarkable speed. Every shock widens the gap between those who can endure volatility and those who are consumed by it. Over time, this compounds into a cycle where power gravitates upward, leaving the majority increasingly vulnerable to the very forces that elevate the few. And as we move into the next layer of this pattern, the silence surrounding insider operations becomes even more revealing. As the gap widens and power concentrates upward, a quieter and far more strategic process takes shape behind the scenes, operating in a world that most people never see. This is the realm of insider movements, a space where information flows before headlines exist, and where financial decisions are made long before the signals reach the public. These moves are rarely dramatic. They unfold through subtle reallocations, discrete meetings, cryptic regulatory filings, and shifts in trading patterns that appear insignificant unless you understand the rhythm of institutional behavior. But once you trace these actions across multiple crises, a breathtaking consistency emerges. One of the defining features of insider activity is timing. There is always a moment, just before a major downturn becomes undeniable, when influential investors begin closing highly leveraged positions, adjusting exposure to vulnerable sectors, or redirecting capital into assets that historically strengthened during instability. These shifts are too precise to be random. The public sees stability. Insiders see a narrowing window. They act not on fear, but on signals derived from data unavailable to ordinary market participants, liquidity models, cross-border flows, derivatives, pricing anomalies, and private discussions with policymakers. These early maneuvers often determine the scale of the wealth they will accumulate once the crisis unfolds. Another revealing pattern is the sudden acceleration of mergers, acquisitions, and private deals in the weeks leading up to a collapse. Companies that seem healthy on the surface accept quiet buyout offers or emergency capital injections from private funds. Executives sell shares at carefully timed intervals, avoiding the massive losses that retail investors will soon face. Even institutional portfolios undergo rapid restructuring, often cloaked within vague statements about market conditions or strategic adjustments. By the time the public notices unusual activity, the repositioning is already complete. Technology has amplified this process. Algorithms now detect microsignals in market behavior with extraordinary speed, allowing insiders to react to shifts invisible to human analysts. High-frequency trading firms, sovereign funds, and global banks use models trained on decades of crisis data to anticipate outcomes days or even weeks before they materialize. While most investors rely on delayed indicators, these systems interpret the future as a series of probabilities shaped by thousands of interconnected inputs. And when those probabilities align, capital moves instantly, quietly, and with remarkable accuracy. Yet what makes these insider operations most striking is how consistently they mirror past crises. Different eras produce different technologies and different geopolitical tensions, but the choreography remains the same. Early signals, quiet repositioning, rapid exits, strategic accumulation during the downturn, and transformative gains during the recovery. The public experiences shock. Insiders experience opportunity. This contrast raises a question that grows more difficult to ignore as the pattern becomes clearer, a question that will shape how we interpret the next chapters of this unfolding structure. Before we continue, share your thoughts in the comments. Do you think insider movements influence crises more than the public assumes? Your perspective helps deepen this investigation as we move forward. While insider movements unfold behind closed doors, another force shapes crises from the surface, the narratives that guide how the public interprets what is happening. These narratives do not emerge spontaneously. They are crafted, repeated, polished, and amplified across media outlets, analyst reports, institutional briefings, and think tank publications. Now, their purpose is not necessarily deception. It is alignment. If public perception remains predictable, market reactions remain manageable. And when reactions are manageable, opportunities for strategic repositioning remain intact. This is why, during the early phases of a downturn, messaging across major financial voices often sounds remarkably uniform. Analysts insist that volatility is temporary. Officials reassure that fundamentals remain strong, and headlines highlight isolated positive data points to balance growing concerns. These statements soften anxiety long enough for powerful investors and institutions to complete the actions they began weeks earlier. What appears to the public as clarity is often a carefully timed delay. The most revealing aspect of these narratives is how rarely they address underlying structural weaknesses. When an industry shows signs of contraction, the explanation focuses on seasonal patterns or external shocks rather than deeper systemic stress. When liquidity evaporates in critical sectors, news coverage attributes it to technical adjustments instead of signaling how close the system is to a tipping point. And when major financial institutions begin tightening credit or restructuring portfolios, the messaging frames it as proactive risk management rather than preparation for a storm. This framing matters because perception shapes behavior. If people believe a downturn is manageable, they maintain their investments, continue spending, and avoid asking questions that might expose deeper instability. Meanwhile, those with access to privileged information quietly position themselves for what comes next. The narratives guide the public through a controlled psychological corridor, one that keeps attention away from the signals insiders are already acting upon. Even more striking is how quickly these narratives shift once a crisis becomes undeniable. Headlines pivot from reassurance to alarm. Analysts highlight vulnerabilities they previously dismissed, and policymakers acknowledge risks that were long evident in private forecasts. This sudden shift creates a sense of shock for ordinary citizens, as if the crisis materialized overnight. But for those who had been following the subtler signals, the shift is simply confirmation of what had already been set in motion. Historical cycles reveal this pattern with remarkable consistency. In the months preceding the dot-com crash, media coverage emphasized innovation and long-term potential, even as insiders reduced exposure. Before the 2008 financial meltdown, official statements downplayed the severity of mortgage instability, while major institutions quietly hedged against collapse. These examples illustrate not deliberate manipulation, but selective framing, designed to maintain order while powerful actors reposition themselves. As you trace these cycles across decades, the pattern becomes difficult to dismiss. Crises may be unpredictable in their exact timing, but the narratives surrounding them follow a script that shapes public behavior with almost surgical precision, ensuring that the greatest shifts in wealth and power occur long before the truth reaches the surface. As you follow these intertwined forces across time, insiders acting early, institutions shaping outcomes, narratives guiding public perception, a striking realization emerges. Every major crisis of the past 50 years, regardless of its origin, follows a sequence so consistent it resembles a template. The pattern begins with accelerated optimism, a phase in which markets soar, valuations stretch, and the public embraces the illusion that growth can continue indefinitely. This optimism is often accompanied by technological breakthroughs, financial innovations, or geopolitical calm that create the impression of a new era. Yet beneath this surface, early signals of instability are already forming. The next stage emerges quietly. Leverage begins to build within key sectors, liquidity becomes uneven, and credit conditions shift in ways too subtle for casual observers to detect. Insiders interpret these signals as warnings, prompting the early repositioning that defines their advantage. The public, guided by reassuring narratives, continues to participate enthusiastically, unaware that the foundation is weakening. This divergence between perception and reality sets the stage for the third phase, when structural cracks become visible but are framed as temporary or isolated. Analysts propose explanations that minimize concern, ensuring the momentum of optimism does not break too soon. Then comes the acceleration. Markets begin reacting sharply to events that previously would have caused only minor fluctuations. Volatility surges. Companies reveal unexpected weaknesses. Governments issue statements aimed at reinforcing confidence, yet their urgency hints at deeper problems. Insiders, having already executed their strategic adjustments, watch as the window of opportunity closes for those slower to react. The public, sensing the shift but lacking clarity, oscillates between fear and hope, creating the emotional turbulence that compounds market instability. Finally, the breaking point arrives. A triggering event, often one that had been visible for months, becomes the catalyst that transforms uncertainty into full-scale crisis. Markets fall. Credit freezes. Institutions reveal losses that contradict their earlier reassurances. The public experiences shock, believing the collapse came out of nowhere. But for those who trace the pattern, the event is merely the final step in a sequence that has unfolded repeatedly across modern economic history. What happens next is equally predictable. As prices plummet, insiders and institutions with liquidity begin acquiring distressed assets. Companies that once shaped entire industries are purchased at fractions of their former valuations. Governments introduce rescue programs that stabilize markets but disproportionately benefit those who positioned themselves early. By the time recovery begins, ownership has shifted. Influence has expanded. And the cycle resets, ready to unfold again with a new set of narratives, new technologies, and new opportunities disguised as unforeseen catastrophes. This repetition raises a fundamental question about the architecture of the global economy and the forces that shape it, a question that becomes even more urgent as we step into the next layer of this story. As the pattern reveals itself with increasing clarity, the question shifts from how these cycles work to what they imply about the future of global markets. If crises consistently benefit the same players, reshape the same sectors, and reorganize wealth along familiar lines, then the next major downturn is not simply an economic event waiting to happen. It is a structural turning point already taking shape beneath the surface. You can sense it in the way capital concentrates into fewer hands, in the quiet expansion of private funds into essential industries, and in the growing influence of institutions that operate beyond national borders. These forces do not merely react to global instability, they define its trajectory. One of the clearest indicators of an approaching shift is the increasing dependency of markets on artificial stability. Central banks intervene more frequently. Governments rely on debt-financed stimulus to maintain growth. Corporations use financial engineering to appear healthier than they are. Each of these actions delays volatility but amplifies the impact when it finally arrives. At the same time, global investors diversify into assets designed for turbulent environments: farmland, rare minerals, water rights, critical infrastructure, and strategic technologies. These moves paint a picture of preparation rather than optimism. Meanwhile, geopolitical tensions intensify the fragility of supply chains, currency systems, and energy markets. Conflicts reshape trade routes. Alliances shift. Nations hedge their reserves against potential shocks. For ordinary citizens, these developments appear abstract, distant, or overly technical. Yet for those familiar with the historical pattern, these are unmistakable signs of a system repositioning itself. The next crisis will not emerge from a single catalyst, but from the convergence of multiple pressures, each reinforcing the others until the structure can no longer maintain its balance. What follows such a convergence is not random. It is a redistribution of power. As weaker companies fall, stronger entities consolidate. As markets correct, those with liquidity accumulate. As public institutions respond, their policies inevitably favor the actors most capable of leveraging the recovery. This is why every major collapse leaves behind a landscape more concentrated than before. Ownership narrows, influence expands, and the cycle renews under a slightly different form, shaped by the lessons extracted from the previous downturn. Understanding this pattern is not about predicting dates or identifying a single trigger. It is about recognizing the architecture beneath global finance and how consistently it channels instability into advantage for a select group. Once you see this framework, it becomes impossible to dismiss crises as surprises or coincidences. They are transitions, and transitions always elevate those who are prepared long before the public realizes change is underway. If you reach this point, share a comment saying this message was for me and tell me how this perspective resonates with your experience. And if this exploration opened new insights for you, consider subscribing and leaving a like, because it helps sustain conversations that reveal what often remains hidden beneath economic headlines. There's another video waiting that expands on these patterns from a different angle, so feel free to continue the journey and explore how these forces shape the world unfolding ahead.